Today we've got an incredibly special guest with us, the one, the only, the George Clooney of the mining industry, Alex Scanlan of Barton Gold. We have here a video of the man himself on site, looking rugged.
Oh yeah.
So he's on site, it's proof he's working. He's a very hardworking man. And we're very lucky to have him today. So, for those who aren't aware, Barton Gold is a gold developer, about to turn miner here in Australia, in South Australia. We're in Queensland today, here at the Gold Conference. So that's why we get to sit down and have a quick chat. Now, today's chat was more of a general, broad sort of chat where we wanted to start off with asking you, Alex, you're a very smart man, you're very accomplished in life. What got you interested in gold?
I guess my background is investment in real assets, broadly speaking, and I tend to sort of work from, I guess my educational background is out of an economic framework. So I'm always kind of looking at markets and looking for inefficiencies. And I do remember in the early 2000s, in the late 2000s, thinking a lot about credit and credit cycles, monetary policy and monetary policy cycles. And the long story short is did some interesting things that were successful on the basis of that analysis. And fast forwarding to around 2015, 2016, I had been thinking about these things again because we arrived, in my view, at a place in the world where post-GFC, Western governments started printing money exactly the way that we learned you don't do, right? I remember the sort of constantly printing monetary policy, which was adopted through and thereafter the global financial crisis. You know, when we were young, we used to be taught how Zimbabwe destroyed their currency.
Yep.
But we basically saw that happening for 6 or 7 years on an extended basis post GFC. So I was expecting to see a really large inflation wave, which hadn't manifested. And with that sort of unseen or not yet realized, inflation wave, we were starting to see sovereign and consumer and corporate credit declining again very, very rapidly. We then had two very important political events, and these both happened in 2016 in close succession. One was the Brexit vote, and one was the US presidential election. And I guess the point I always make about this is everybody tends to have an opinion about these two things, and they tend to have a very strong opinion about these two things. And I have my own opinions, of course, right? And mine are maybe a little bit more cerebral than others, but I think there are some times in life when you can just step back and you really need to just look at the event and what the event tells you, and kind of not focus on a lot of the noise and dialogue about what is this all really going to mean, because a lot of the noise and dialogue is just people needing to make copy by 4 p.m. for the newspaper or the now digital equivalent, right?
Yep.
But to me, those two political events were essentially two separate, but in some ways related, socially related events that represented the two leading Western liberal democracies, the real kind of champions of the post-World War II NATO-led order, saying NATO-led globalistic order, right?
Yes.
Globalization is ridden on the back of the sort of perpetual influence and expansion of NATO's leaders. That was those two key players saying, hey, this was really good for a while because we were getting a lot of cheap toys and we could buy a 70-inch flat screen television for $600 instead of $6,000. But it looks like this has really not worked out too well for us. We're going to pull back, right? Like we're looking inward now. We had reached a point in the world where, again, credit's not great at any level. And people were already starting to get slightly agitated with one another around, international trade and all these things. So if you pull back, right, if you're the ever expanding balloon that then pulls back, and more than that, pulls back and says, by the way, we're now starting to question all of our international, trade and geopolitical and military relationships. And that might mean tariffs. Well, if you're in the first instance, if you're worried about an inflation wave, a tariff is a structural inflation uplift, right? So that's a big one. But the bigger thing to me was when you have two people that are so central, and this is really the U.S. in the majority, when they pull back and they start not only pulling back from people but poking them in the eye while doing it, you're creating space between you and your traditional allies. And space is a dangerous thing in the geopolitical universe, right? You create room for your competitors to come in. Those who see you retreat, who sense a weakness in the order, in this case, the post-World War II NATO-led order that they have always resented, that's a weakness for them to come in. And my theory was that we would actually then see essentially the emergence of greater geopolitical competition alongside the emergence of greater trade competition and the fracturing of traditional military alliances. Now, so I think we got that right.
Right? I'd agree with you wholeheartedly there.
What I got wrong in so many words is how quickly that would happen. And we can look out across the news headlines today, and pretty much anywhere you're reading your news, you can see how different the world is operating today than you would have expected it to operate even 2 or 3 years ago. The threat of putting space between you and your allies is not only the threat of an inbound opponent trying to sort of exert influence, which China has done. They've taken this opening. But if your allies decide that maybe they're not going to stand against you, but they just won't stand so close to you, that is a very significant weakening effect on your position as a global leader. But we've now seen in the course of, in particular, this Iran conflict, we have actually seen U.S. allies saying no to the U.S. and standing against the U.S. In a way that 10 years ago would have been unimaginable, and is the first time it's happened really en masse since the end of World War II. No, you may not use our air bases to stage this thing that we consider possibly unlawful, incredibly dangerous, and nothing we want to be a part of, right? Then trouble unrolls, right? And the demand goes out for support, and the answer is universally no. We have actually moved right past that point where allies are not standing so close to where they are actually now stepping away and saying no, and essentially standing against, right? And that represents a very profound change. So anyway, the evolution has gone faster than I anticipated, but what I expected was we would see structural inflation adjustments. We would actually see an inflation wave rising. We would see stress in credit markets. These things all started happening around 2018, 2019. They really started coming to the fore, and then we had this miracle, and it was called COVID. And COVID was the excuse for Western governments to just unleash the printing press again. And that essentially stabilized nominal asset markets, right? There was a shock, but look what's happened to asset markets, financial asset markets over the last couple of years. They've gone up 100%, right? 200%. But all of this is just paper-based, right? So what it's really done is it is inflating, essentially, or it's debasing these currencies that I was already really worried about. And now that we have opponents standing, or allies standing against the U.S. as a credit issuer, people are really, really questioning, do they want to hold U.S. paper? De-dollarisation is actually happening faster. And we're just, there's a lot going on, and it's very hard to distill this, but the core of this thesis was if all of these things happen, it presents a weakness for the US dollar, which most allies actually resent, because the US banking system and being able to transact in SWIFT and US banking, within the US banking system, imposes an incredible cost upon smaller economies. And you can measure it in percentages of GDP. So, the incentive now clearly that the US is somebody they are really worried about is to move away from dollars even faster. And that just, to me, puts even more strength in the thesis that if you're going to have de-dollarization, something else has to remonetize, right? Something else has to be the new agreed geopolitical destination for reserve storage.
Yep.
And there is only one asset in the world that has done that successfully over time, and that is gold, right? As we all know, there's no counterparty risk. People can't turn off your gold deposit, right?
Yep.
Well, at least if it's stored in your borders.
Yes.
So that's all a very long way of saying that my view was we would see de-dollarization coming from all of these things, that you cannot have de-dollarization without the remonetization of gold. And fundamentally, the scale of that had to be quite significant because we now have to essentially reverse 50 years of, well, basically a 50-year aberration in how people view money in the course of some shorter period of time as people essentially panic away from the US dollar.
Yeah.
And consider that, we've been moving gold to the margin for 50 years and essentially demonetizing gold. We've commodified the US dollar. We've managed to convince people that if you have a US dollar, you can get anything you want, including energy critically. So have a dollar to get energy and you're fine. Well, we now know through with geopolitical competition rising that a dollar no longer gets you what you want if your opponent controls what you want. So now having the physical commodity is really critical.
Yep.
Right, and people don't want to settle as much in U.S. dollars. They're starting to de facto settle a bit more in gold. So this is all accelerating. On the one hand, it's exciting for the thesis, but the thesis is winning for a lot of bad reasons, and we've had a lot of catalysts in there, including the U.S.'s fateful decision to sanction Russia's treasuries.
Yeah.
That was proof that treasuries are no longer a reserve.
Yep.
Right,
and that wasn't even done in World War II.
Well, to my knowledge, to my knowledge, correct, right? I mean, other terrible things were done in World War II.
I was going to say, lots of bad things happened. The BIS, though, it facilitated gold movements between the Allies and the Axis. So even in the depths of the war, when young men were shooting each other in the trenches, the different sides still respected each other's money, which we've seen being completely removed with, like you've said, the seizing US bonds off Russia.
Yeah.
So I'm right with you, and I agree with everything you've said. The de-dollarization, I love what you've said about de-dollarization requires something else to move into. As a bullion dealer, we see all sorts of speculation around what the next currency system looks like, whether it's BRICS and their central banks and gold-backed currency, or the gold-backed one, or a fiat one, or who knows.
Yeah.
Ray Dalio's got his ideas about a rising Chinese empire, a falling US empire. There's all these ideas out there. I love your analysis. I concur with it myself, absolutely. We're at a gold conference, so that makes a lot of sense. I guess the next question I had for you is, you've been talking about de-dollarization, the geopolitics of the situation, which I absolutely agree. It's so important. Most people don't understand it. Allies moving away from the US dollar, China massively swapping US treasuries for gold at the central bank level. Everything you're saying is absolutely true, can be verified with data. Feel free to not answer this, but where do you see things moving geopolitically and monetarily here? Do you see some sort of Chinese currency? Do you see some sort of gold-backed BRICS currency? I mean, I know this is speculation and I'm not going to hold you to it, but what's your thoughts?
Well, we do have a Chinese currency. You have renminbi inside China and yuan outside China, right?
Yeah.
And China is very successfully essentially distributing this into the market, and people are becoming more and more willing to trade in it, to accept settlement for their goods and services in renminbi. One of the reasons being that even if they don't really want to hold renminbi, it's now gold convertible, right?
Yes.
China has created gold convertible, essentially has created gold convertibility around this. And the clever element of this, which I think is kind of lost on the Western community, the Western thinking community, and I think Xi Jinping is a very, very clever guy, and even the way that they say things is very deliberate, right? He came out and he said, look, we want to make the renminbi a reserve currency. I think that they very much do not believe that specific statement. I believe they set it that way because that's the way that they know that Westerners will understand it. What they want is for the yuan to be accepted as a transactional currency, but not held as a reserve asset.
Right.
Because if it's held as a reserve asset, it falls into the same trap that the US dollar falls, right?
Yep.
People won't use the yuan to buy products from China, essentially selling the yuan to buy the product and keeping the yuan cheap. If they hold the yuan, if they're demanding the yuan, then the demand shifts to the yuan as opposed to the goods. And they end up in the same trap that the US entered, where all of a sudden the yuan is getting revalued and it's too expensive to utilize Chinese manufacturing and labor. They have very, very, very astutely absorbed the entire advanced industrial base and advanced industrial manufacturing base of the world. They have no intention of losing that because it is now their advantage that now that we move back to a world and an environment of true geopolitical contest, right? We've all heard the analogies about how many missiles and things they can turn out versus, the very fatty, slow US system.
Shipbuilding for their navy.
Yeah, so they're not going to give it back, but their intention is to create a multipolar currency system, right? And essentially the question that I ask then is, okay, well, if you want to trade in these two poles, and basically there will be people who are kind of like forced or coerced into staying really, really close to those two poles, but most people will be somewhere in the middle. Most marginal economies, and this will be advantageous to marginal economies because instead of having like a monopolar system where they have no other choice, now they've got China as a true kind of pole ally counterbalance to the US dollar system. Essentially, the US dollar-based pole or team dollar and team yuan are going to be bidding and competing to attract the man in the middle,
right?
In a way that didn't exist before, I think.
Yep.
That this will lower their transaction cost. This will give them more opportunities. This will increase the value of their assets. This will increase the value of their labor. It will give them a greater voice in things. Now, there is also the element of you're choosing, between one or the other, or if you are in that magic in the middle spot where you're the marginal vote that's highly valuable, you can choose both. The question is, if you've got dollars and you've got yuan, what's your doorway between these two new large poles? It's gold. It's assets that are convertible into either dollars or yuan. And that is gold, because for everybody outside the dollar system, gold is the center of the monetary system, right? Whereas in the US, that may become more true over time. We have now started to see the US exporting a huge amount of gold. So whether the American economy is yet fully aware of why it's happening, they're de facto settling nearly 10% of the trade deficit in gold, which is that is absolutely stunning. That data has cropped up in the last 4 or 5 months. So the U.S. had about a $900 billion trade deficit in 2025 and exported about $85 billion worth of gold, the vast majority of which was in the second half of the year. Okay. So if that data continues, then what it means is, the beneficiaries or the trade creditors are taking their surplus, and instead of buying U.S. treasuries, they're just buying gold in the U.S. in physical form and exporting that and taking it back. Yeah. So it's de facto settlement of your trade in gold. And if the U.S. is being put to settling 10% of its trade in gold, what of the rest of the world? If this is a benchmark for the new equilibrium component of gold and trade settlements, the amount of physical gold required to be held in stock for countries, particularly those who don't export a physical product that they can leverage in trade, the amount of gold they must hold in stock to be sure that tomorrow they can get energy, that tomorrow they can get other inputs they need, is a large multiple of what they have today. Yeah. And with inflation, the nominal value of trade is going to keep growing. So the nominal value represented by that gold has to keep growing, which in my way of thinking is very bullish for gold.
Yes.
And central governments are going to do the work for us over time, continuing to debase currencies and continuing to inflate that value.
Yep. Well, I like what you say there about central governments and central banks doing the work for us. I mean, In some ways, it's quite easy to be a gold investor. You look at the central bank, you look at the money printer, you look at inflation, and you pick gold. And it can be quite simple, or it can be quite cerebral, which is something that is great to have you on today. I guess the next question for me then is, we've talked a lot about gold, the geopolitics of it, a fascinating conversation, and one that I haven't seen others have. Thoughts on silver?
So silver, I have probably a different view on than panel conversation earlier today, right? In a precious metals investment forum. If you have looking at gold and silver side by side, there's a lot of investors who look at silver as like the cheaper little brother to gold, right? And there's certainly very good evidence that you could trade them together or against each other, right? And we heard that from some very Sean Rousseau, literally was I think Australia's biggest gold dealer in the 1990s when he was running the desk at Rothschild, right? So this is a guy who really, really knows gold. But he said he sold his gold to buy silver when the ratio went to 100 to 1, and now he's rotated that back over to gold now that the ratio has dropped 50 to 1. So they are probably, in some ways, more useful as a pairs trade or comparator to one another. And I think that's a very useful way to think about the world going forward, is the patterns and structures that we're used to are resetting. So reversals of trends and relationships is a great way to make money if there's a consistent trend. I look at silver more as an industrial metal. And I think I like that. I guess I'm actually happy with that interpretation for us, because if you go back a few years in time, if you could have had two ideal metals in your deposit, it might have been gold and copper, because they were counter-cyclical to one another, right? So when gold in kind of a bust or an inflationary cycle, when there was economic problems, consumption of copper might go down, but your gold price was going up. So they were a nice hedge to one another. Now it's a pretty good argument that, well, gold's just broken that inverse relationship and everything just goes up, right? But I always really liked that idea in a portfolio. Evolution mining, for example, had that approach. Silver, I think, has really adopted that same sort of base metals thesis or industrial metals thesis that copper was able to offer, because you get to pick up industrial demand. You get to pick up monetary demand, right? If people are investing in silver, and there's a lot of people looking to buy streams and royalties and get control of the physical from a financial or investment standpoint. But a lot of them are doing that because they're basically stockpiling and trading through to industrial users. So you pick up a genuine supply and demand based metric, which gold doesn't really have a demand function for industrial use. There's a small component of it, but it's never been able to benefit from that because it's just too heavy and too expensive. But with the advent of modern solar panels, industrial consumption of silver is going up considerably. So I think you have an extra tailwind inside of silver over the long term versus perhaps copper, right? You get the monetary element and the industrial element. We have a silver credit in our Tunkillia project. So for every 1 ounce of gold we produce 2.5 ounces of silver. That obviously in recent months has become a far more attractive credit. I think when we modeled the project in 2025, we used $50 Australian silver. And that was basically a $100 million credit. That is now, it's fluctuating between, $200 and $300 million credit. But that's real, that's real money. I mean, people build entire mines to make less than $300 million, right? So that's a valuable credit for us at Tunkillia. And I've become more interested in silver because we've made a really high grade silver discovery. So now I have to actually start thinking about this. I have to really ask myself, if this turns into a very high grade little deposit, if we have X ounces of silver here, how do I monetize this for our investors, right? So we think of all of our assets basically as a portfolio strategy. How do I monetize this? How do I get the greatest value back to our investors, whether it's leveraging this asset to fund the rest of the platform? And we were kind of joking internally that it could be that silver builds our entire gold business, right? You can look at monetizing that underneath the gold business. You can look at monetizing it outside of the gold business, right? Will silver, and for those who aren't familiar, we drilled literally the highest grade silver drill hole in the world in 2025.
Very impressive, by the way.
And very surprising because that is a 130-year-old high grade gold district with no mention of silver in the literature in any notable sense. Silver is like a minority accessory. So for 5 ounces of gold, you get 1 ounce of silver, in your doré. The drill hole that we drilled was 6 meters at 4,750 gram per ton silver, plus a 13 gram gold credit, less than 50 meters from surface. So we've got a relatively small footprint there. We're going to go drill it on a different orientation at the end of May, early June. If that infills in that little footprint, you could have 10, 20 million ounces of silver in a tiny hole. So I've got what would best be described as a minor satellite pit that can produce a greater profit than the entirety of most gold mines that we present against. How do you monetize that efficiently, right? Is that so valuable that the market just can't value that inside of a gold company? Well, maybe you spin that out and develop it separately. You can bring in a partner and sell an interest in that, or do a deal where you're funding your portfolio, but also you can spin shares out to your Barton shareholders, right? Now somebody's got, for want of a better example, Barton Gold and Barton Silver. If you like both, you can keep both. If you like one, if you like the other, you can keep one, sell one. But that's the way that we sort of think about silver now and thinking about how we maximize value. So
yeah, I love that. It's fascinating to me to hear how miners such as yourself, they conceptualize the different metals and how they fit in. I mean, a gold and copper miner, I hadn't thought of it like that they counterbalance each other cyclically. Gold goes up when times go bad, Dr. Copper goes up when times go good. Like you say, we've seen both rally over the last year, copper up 40% or so, gold outperforming. What a time to be alive. Yeah. So I find it fascinating to hear that insight from a prominent gold and upcoming silver miner. So as a Barton Gold shareholder, I'm incredibly excited by everything that you're saying. And as a silver bug, I'm incredibly excited by what you're saying. I mean, we've discussed this as well, off camera, of course. I am very, very pro-silver, very pro-silver. I like gold. Gold's great. And I started trading gold before I started trading silver, 2 years before I started trading silver. So it's interesting to hear that mindset on it. I guess my next question is, you've got this amazing asset, right? I'm a shareholder, not financial advice, of course, but I'm a shareholder, I'm very excited. What made you pick Australia?
Well, like going back to the original thesis of, going into gold around 2015, 2016, that thesis was based in large part around instability of traditional trade military alliances. And when you see instability in these alliances and people challenge traditional boundaries, you tend to see lines of control changing, right? So you think of like the Maginot Line, the boundary of control and, East versus West, controlled Europe, or, maybe good versus bad controlled Europe. Look, you very quickly come to the conclusion, if you think the world's going to change and you don't know who's going to be in control of certain places, that the jurisdictional risk of a lot of places goes up. So you see some very exciting deposits in some very interesting places, and they're interesting places that I would want to visit, but they're not interesting places I would want to put $50 million or $500 million into. And we are now seeing jurisdictions that everyone was trying to convince me were safe 10 years ago, losing world-class assets to the man with the bullet.
Yes.
Right? Little piece of copper shaped like a boat is more powerful than that company. And that's reality. That's how the real world works, right? International law is an idea. It's a polite idea, but the man with the gun always wins when he walks in the front gate. So I didn't want to go into jurisdictions that I thought were subject to essentially change of control.
Yeah.
And I was in Australia. I've been here since 2009. And I put it this way to somebody the other day. I am very excited for Australia because, particularly given my views of how I think the world is changing, and how I think that real assets will remonetize with inflationary factors and also industrial competition. Countries printing money to get a hold of physical metals. What does Australia produce? Food and metals. I think that Australia, whereas the US probably has had its best 50 years behind it, I sort of see Australia like 1970s US with this huge pathway of opportunity ahead of it. And I count myself incredibly fortunate to have found myself here and to be a part of this. And now, I have to say, as this has progressed, I only see it getting better and better. The other great thing about Australia, in particular, is, one, you've got tier one geology, as opposed to Canada, where you've got tier one geology. In Canada, you've got 17 mountain ranges you got to build a road across. Australia is largely flat with established infrastructure, so you can actually develop assets more easily here, right? And we bought assets that had an infrastructure advantage. We have the only gold mill in the region. The transnational rail line runs right through the middle of our projects. The main highway runs right past them. So we picked infrastructure advantage in a tier one geological jurisdiction with tier one people, with the world's top safety record in a place that, look, if the change of control happens here, it's like, we were the last stop, right? Like, things have gone past, survivability. So in all respects, we really believe that Australia was like the best place to be, and we were already here. South Australia, no one was looking at it. Everybody went back to Western Australia and Queensland. We saw an opportunity. We consolidated the entire district. We've now built it up while no one was looking, and we've got a platform that can deliver near-term production, medium-term scale, long-term consolidation, at a mid-tier level and continue growing from there.
Well, it's very exciting. As I said earlier, I am a shareholder, so I'm very excited for the future. And as an Australian, we're very, very glad to have you here on our shores. And I love what you said there about the 50 years ahead of us. Metals and food. In a world in which you expect the price of metals to rocket and the price of food to rocket, when you put it like that, it's not a bad time to be in Australia.
Yeah.
So I want to thank you for your time, Alex. You're an incredible man. You're a very busy man, 18-hour days to make the shareholders, myself, value. It's much appreciated, by the way. So thank you for taking the time with us to have this podcast today. Can't wait to catch up with you again at the Sydney Gold Conference later this year. And what a time to be alive. Thanks, everyone.
Thank you.